Hey everyone, Douglas here, and welcome back to the MMT Macro Trader in this market recap for Monday, December 19th, 2022. Tonight I want to discuss the recent selling that we have seen as this market has been once again gripped by the bears, and we've seen one heck of a sell-off since the FOMC meeting on Wednesday and the rate hike decision that came out in the overly hawkish, overly more than expected hawkish Fed announcement on Wednesday. Of course, last week we saw the CPI data come out, gave a momentary pop that faded, and then ultimately by Wednesday, as the FOMC data came out, this was a market that was all but back in control of the bears here. And a couple quick thoughts. What I want to do, the main focus of tonight's update is going to be on the FOMC, and particularly, I think the one thing that we need to be keeping an eye on for when the Fed might finally take their foot off the gas in the rate hike cycle, and why it might be ways away until we finally see that. But I do want to give just a few words in terms of kind of how I think the last few days have played out. There have been a handful of headwinds here for the market. The main structural ones have been the credit cycle that has just been depleted for the majority of 2022. If you're a Patreon member, I just put out the macro update for this week just about an hour ago. Check that out. I kind of give the lay of the land there and the data in terms of what we're seeing. Possibly, maybe a bit of a reversal in that credit cycle. We might finally be bottoming out here, maybe a bit of an credit expansion on the horizon, but that has definitely been one of the main headwinds for especially the second half of this year. Obviously, things kicked off with the massive fiscal drought that we saw to kick the year off. And the other thing that has just really been the reason for the violent selling that we've seen and the selling that just picks up so quickly has been this overhedged market. And the dynamic hedging that takes place, the reinforced selling that takes place in an overhedged market, where the selling just kind of becomes a self-fulfilling prophecy that creates more selling, and certainly we're seeing that play out. We just have not shaken that entire environment this entire year. I do think, and again, if you don't follow me on Twitter, make sure you follow me over on Twitter, and I always keep the link in the description below here. But I laid out kind of my bull case for 2023 in terms of why I think we will likely see a bullish market emerge in 2023. But as it stands right now, every element has not exactly aligned. The planets are not aligned yet for the bullish market, and any position that I have taken, any bounce that I've tried to get in on the S&P here has been a relatively small position that I'm willing to cut quickly, and ultimately did as things fell apart. It looked quite obvious after the FOMC announcement that the volatility structure was pointing towards more volatility. So I still am hopeful into 2023 for a bull market to emerge, but as it stands right now, again, the two major components that have been, especially again in the second half of 2022, in terms of just overall headwinds to this market, the credit cycle and the over-hedging of this market remain. Again, I think there's really strong reasons to believe that we can shake that. The fiscal flows are going to be extremely strong heading into 2023. Check out my Twitter thread that I posted just the other day in terms of what the overall outlook is going to be, solely from the payments on outstanding bonds. The interest payments are going to be through the roof as we head into 2023, but we still have some components that are quite the impediment to markets in the here and now. So one of the things that happens too, and just to kind of set the stage, what we're going to look at is the FOMC, during the FOMC, the minutes and the meeting that followed, or I'm sorry, the meeting that followed, and the initial statement during the rate hike itself. It was very clear that this is an employment and an employment-only thing. The Fed sees employment way too hot. The Fed sees wage rises continuing to increase, and in their goofy ass model, they think that they're going to continue to hike rates, and that's somehow going to bring an end to the wage pressure that we're seeing. I made the case why maybe there's a backdoor way for that to affect things. Probably not anything likely immediately going to happen. I really think what we're going to continue to end up seeing is just the normal cycle play out that plays out as is during any financial cycle. And if anything, we could possibly continue to see this economy run pretty hot through 2023. Again, check out the Twitter thread that I had on that. But it's really going to be employment. So what I want to do is look at a few ideas that I have with the employment data, with the Fed funds effective rate, and try and see how far away we might be, or what would the signal be for the Fed to finally change change course and go ahead and relent on the rate hikes. And before I go into the details too, one thing to mention, I mean, I think one of the reasons why we see, and I mentioned this in the past and I'll mention it again, one of the reasons we see sudden selling when the Fed comes off as more hawkish than expected is really because of the dynamics that are at play, particularly from big institutional investors or investors that are trying to value a company based on some sort of discounted cash flow model. Interest rates do play, because they're a risk-free rate, they do play a role in that sort of price into the market overall. So if the market anticipates that rates are going to be higher than what was kind of initially expected, you're going to see the valuation of every company get affected because of that, and therefore oftentimes you'll see selling. And then what takes place ahead of that is essentially an insurance bet in the options market that says, hey, if there ends up being a more hawkish Fed than expected, then we're going to want to hold these kind of insurance bets via puts. Those will pay off. More puts will get opened. The cycle kind of repeats, and that puts downward pressure on the markets. So I think that is likely what played out after the FOMC. And it'll be, I mean, that dynamic is relatively short-lived, but it has been the dynamic that we've seen play out over and over and over again this year, in part just because of, one, we saw drop off in the main kind of macro data that drives the overall economy. And then two, as we've been into the later stages of this, it's been more of a self-fulfilling prophecy, reinforced sort of cycle. So keep that in mind as well, that I think that's really why we see the sudden sell-off, is it really has to do with immediately the hedging activity, that is these bets that are placed because of these hedge bets that are placed because of the anticipation that the valuation of the companies relative to their cash flow is going to be reduced. And since you can get now almost, 4.5%, 5% risk-free, you're going to take it if a company is that you're investing in is relatively shaky and based solely on kind of future cash flow. So there's that explanation. Anyway, the Fed made it very clear that they're going to keep the foot on the gas until employment starts to look shaky. And I don't know exactly why this dynamic plays out, but it is definitely observable in the data, and it definitely seems to make sense that, it makes sense why this data causes ultimately some sort of recession to play out. We'll talk about that, but why it seems to correlate with the Fed finally taking their foot off the gas, and why rates start to roll over when we see this particular anomaly occur. And it really is the rate of change of the unemployment rate getting into positive territory that seems to be what the Fed looks at, or correlates to something the Fed is looking at that says, yep, it's time to slow things down. And you can see, heading back to the early 1990 recession, when we started to finally get above the zero line here, that is when the Fed effectively started to take the foot off the gas. Big way heading into the dot-com bubble collapsing again as we started to accelerate in unemployment. Again, so you have the unemployment level, you have the rate of change of that, which is the unemployment rate, and then you have the rate of change of that, which is what I now have on the screen, getting above zero. You start to see then the massive acceleration of the unemployment rate. Obviously, at that point, the Fed realizes, okay, we're going to be in a recession. They drop rates. Same thing heading into the great financial crisis. Obviously, the COVID, we'll call it the COVID financial crisis, played out quite differently, and that was very short-lived. But we are now getting once again into that same sort of cycle where we're going to see employment get tighter and tighter, and eventually these sort of same dynamics play out. And I think that's what the Fed is going to look for. And if that's the case, I mean, we could have quite a few months before we get to that point, and then even more where we could just trend sideways for a while, which seems to be the case, where we get this kind of moderation that occurs prior to a larger crisis. So the way I'm seeing the data, I don't necessarily expect this entire cycle to change anytime soon, and I don't expect us to storm higher in terms of unemployment anytime soon. I mean, the economy is looking relatively hot right now, and so there's no immediate reason to believe that this is we're going to pass the 0 point on the rate of change of the unemployment rate and somehow start seeing this kind of cascading unemployment. I will bring bring out this other point too regarding the seeming correlation between this sudden acceleration and at least the last two major recessions as we pass the zero line. And I think this makes a lot of sense because if you take a look at the work that Steve Keen has done in his Minsky software, and you take a look at how really it's the workers that are really the ones that are kind of getting compressed in the business cycle. They're the ones that are kind of eating the cost of the debt cycle as well, with lower wages relative to the entire output or the entire GDP. As that cycle plays out, there becomes this point where kind of a point of no return, right? And you've seen this play, and if you've looked at his models before, you'll notice how this plays out, where you really kind of get this Minsky moment where you're just going to get a collapse in profits. You're going to get essentially a stoppage in hiring, which is obviously going to collapse wages for workers, which is going to collapse demand, and you truly get kind of a demand driven depression that occurs. So I think that is the natural progression that happens in any kind of capitalist credit money driven cycle that will play out regardless of what the interest rates do. And I think what the Fed doesn't understand is that is the actual dynamic that's going to cause the unemployment. That is a dynamic that is going to be quite scary if it does end up playing out sooner than I think it would be expected, because what's going to end up happening here is you're going to get a situation where your biggest issue, the biggest component to unemployment right now, or I'm sorry, not to unemployment, to the inflation that we are seeing, is a supply side issue. We just don't have enough output. And if the Fed somehow is successful, or if the kind of economic cycle plays out, we do get a massive wave of unemployment, you're just taking more output out of the system, right? You're not solving the inflation issue. You're just removing output. Yeah, you'd remove some demand, but the demand will still be there. People still need to buy groceries. I mean, it's still going to be there's still going to be demand. Maybe some asset prices might come down, but in terms of the stuff that is actually being an impediment to people's day-to-day lives, that's not going to be solved. We're going to go in the exact opposite direction if we get a massive wave of unemployment. So hopefully, I'm right. The Fed is wrong in that we can see continued strong employment, at least for another, say, year, 18 months, 2 years as the next credit cycle plays out, and that we can get back to kind of a more maximized output, or at least close enough to a maximized output to at least allow the inflation situation under control. And then, the credit cycle can play out, and maybe the recession won't be as bad when we finally do get there down the line. But in the meantime, if it somehow does happen sooner than later, it's not going to solve the inflation issue. It's only going to make it worse if and when that were to finally happen. But again, I don't think we're that close to that scenario playing out. I still think we have some time for this cycle to extend. I think actually we're likely going to be seeing another credit cycle, another credit expansion hit, which should push asset prices higher, given the way the fiscal flows are right now, given the just the massive injection of capital into the finance system through those fiscal flows. It's kind of adding up that I think 2023 could end up being a pretty bullish year. But I'm going to talk more about that on Wednesday as I wrap up here. Wednesday is going to be a live stream, so if you're not subscribed and you don't have that notification bell turned on, do both of those things. You're not going to want to miss Wednesday. I have something pretty special lined up. Part of the reason I haven't been active for the last 2 weeks, I've been in the lab working on some pretty awesome stuff that I'm ready to start sharing on Wednesday. I have a special guest. You're just not going to want to miss it. I'm going to hype it up a little bit. You're going to want to be there, bring your questions, and be ready to go on Wednesday. It'll be 8 p.m. So Eastern time. If you're not subscribed, if you don't have that notification bell turned on, get subscribed. And if you found this video helpful, make sure you give it a thumbs up. And final thing, if you're an active trader, active investor, and you like what I'm doing here, make sure you check out my Patreon page. Link is in the description below. That's where you can get daily updates, all my research over there. I extended the promo price for the month of December, again in part because I'm working on some pretty fun things, ready to roll those out, and the promo price will go through the end of December, and then I am going to go back to it'll ultimately be a 3-tier system, but we'll explain that at another date. So patreon.com/MMT Macro Trader if you are interested in that, and again, just link in the description below. So that's what I have for tonight in terms of how I think the whole Fed thing is going to play out, when the rate hikes might finally stop, and what to look at in terms of data, particularly unemployment data, which seems to be the main component that the Fed is interested in right now. It might be a little while before the Fed finally sees what they need to see to go ahead and stop the rate hike cycle, and probably anticipate more rate hikes into the future. So that's where, that's where I think I'm going to end things for tonight. So until next time, everyone, good trading, and we'll talk to you then. Bye-bye.